We have heard a lot recently about corporate governance. Since Enron filed for bankruptcy in the year 2001, a string of corporate scandals has made corporate governance headline news around the world. These scandals have made it very clear that governance failures have serious and far-reaching consequences for all of us. When a listed company goes bankrupt, with investors' money missing and the directors nowhere to be found, everyone knows the meaning of this corporate governance failure. It means job losses and financial losses, and perhaps, most importantly, a loss of trust in securities market and the company listed on them, which threatens the very foundation of our entire global economic system. In this series of programs, we will be asking a wide range of people for their views on the major corporate governance issues facing us in Hong Kong and the Chinese mainland. How do our standard of corporate governance compare with those in the other parts of the world? What needs to be done to improve areas of weakness? How important are culture and ethics to the creation of a good corporate governance environment? The 5 programs in this series are the results of a collaborative effort between the Hong Kong Institute of Chartered Secretaries and the Open University of Hong Kong. Our intention is not to argue a particular case. The idea is to create a forum where the different perspectives of investors, regulators, financial professionals, company directors, journalists, academics, and independent corporate governance experts can be heard. These programs will give all of these perspectives a voice, and it is up to you, the viewers, to form your own opinion on this ongoing corporate governance debate. In this first episode, we start with the seemingly simple question: what is corporate governance, and why does it matter?
Well, basically, I'd say corporate governance is about how companies are directed and controlled. It's a fairly simple statement, but I don't think it's all that well understood. Directed refers to the way in which the board directs and gives guidance to the management of the company. Control is about the way the board supervises the management, but also about the internal controls and the risk management within the company. So it's governance as distinct from management. Management is about operating the company. Governance is about how you supervise management and ensure that you have the right checks and balances in place. There's certainly more than one definition. I mean, there's obviously the shareholder-focused definition, there's the stakeholder-focused definition. I think sometimes those distinctions don't necessarily make a lot of sense, because shareholders, after all, are stakeholders as well. And there are other financial stakeholders like creditors that also have clearly a claim upon companies. So simply drawing a distinction between shareholders and stakeholders is often, I think, somewhat false. Secondly, you have to run a company being cognizant of your stakeholders, your creditors, your employees, the wider social issues that you operate in, particularly if, for example, you're a multinational operating in an emerging market. You do need to be aware of political issues and social issues. If you're a large multinational, you also need to be aware of environmental issues. So, I think when you're running a company, you would take naturally all of those issues into account. It matters because if you want a company to survive, it needs to be well governed. A lot of companies don't survive for very long, and that's often because they have a flaw in their governance. It may not be because they don't have good entrepreneurs that have good ideas. It may be that the way that they've run the company, they haven't managed their risks properly, or they've allowed fraud to occur, or they've allowed their brand, their reputation to be damaged. Most companies don't last for all that long, so that's why corporate governance is fundamentally important.
Corporate governance is a series of codes, practices, self-regulation, obligations, hopefully lead to better management of public companies in particular, and hopefully leads to improved shareholder returns. Well, yes, it matters in as much as in an economy like Hong Kong, where we have such a tremendous percentage of the stock market capitalization as a ratio of the overall economy, it matters. It matters because people's savings are invested in the stock market. It matters because so much of our activity is tied to the quality of the companies in the market. It matters because the cost of capital that an economy is able to bear, its best companies are able to achieve, has profound impact for the level of growth, the level of employment, the level of income growth through the economy. So in terms of linking corporate governance to more general economic welfare, yes, and I think there's a very measurable connection there.
Corporate governance, okay, I would define it, sounds simplistic, but it's really the system and processes by which companies are governed. What I would say as perhaps another question is, how would I define good corporate governance? And that would be, how does a company go about complying perhaps with the spirit of the regulations, going above and beyond what's required as a minimum standard? I think complying with what a company has to comply with in terms of regulations and rules is not necessarily good corporate governance. That's just a requirement. The good corporate governance, and with the emphasis on good, is going above and beyond what's required as a minimum standard. Corporate governance has been around for many years. I think the prominence being given to it is what has increased probably quite dramatically certainly in the last 10 years, if not the last 20 years. I think much wider share ownership has given rise to the need for a greater emphasis, and probably the reason why greater prominence is given to this. I think
I look at it as being the systems by which a company or an entity is governed, and the processes by which that entity reports to its stakeholders in the widest sense. Companies are no longer individuals. Companies represent a lot of people. They have a lot of people who've either put money into them. If they're companies, entities, whether they're government bodies, they have responsibilities to wider groups of people rather than just those who are sitting within the company making decisions. So they have to report. But also governance is very important because you need to make good decisions, and in order to make good decisions you need to know what you're doing, so you need to have processes by which good decisions are made, and that's all forms part of governance, because unless you have the right systems you can't make proper decisions.
Well, I think you can look at it in a variety of different situations, and I think primarily today we're talking about how corporate governance makes a difference to listed companies. Given that the public are quite often putting significant sums of money into listed companies, they have an interest in knowing that that money is being looked after properly, that the directors are meeting their obligations of stewardship and are ensuring that adequate information is provided to those investors to allow them to make decisions about whether to hold their investment or to divest. Corporate governance matters in varying degrees to a whole range of parties that may have an interest in the area. If we're looking at the hospital authority, governance means something in a different way to the hospital authorities compared to listed companies.